Good morning, all. Welcome. Please take your seats and we'll begin. We've got a lot to do today and not much time to do it, which always seems to be the case with these academic sessions. You've come into the Natural Capital session, the first of 5 on the PRI Academic Network program. They'll be introducing 10 papers that are worth your attention. I think if you go to all 5 sessions, I think you get a master's degree. Before we start that part of the conversation, though, I have a little bonus here at the start. I want to introduce you to Maria Elena Drew, Director of Responsible Investment Research at T. Rowe Price. T. Rowe is sponsoring the PRI Outstanding Research Award this year, so we're very grateful. Maria, would you like to take the stage?
Hi, I'm Maria Drew, the Director of Research for Responsible Investing at T. Rowe. I'm very delighted to be here today to open the Academic Network Conference at PRI in person 2024. So this is T. Rowe's 4th year serving as sponsor at PRI, and we're really excited this year to be sponsoring the Academic Research Prize. So as a large global asset manager with 1.6 trillion of AUM, we keenly understand and deeply value the importance of research in the context of creating high-quality investment returns and outcomes for our clients. This deep commitment to research extends to environmental, social, and governance, as well as the more traditional investment research frameworks that we've been using for many, many decades. So any investor worth their salt wants to understand the company or other securities that they're investing in from every angle possible. Any good PM doesn't ever want to be surprised. And I think at T. Rowe, our view is that ESG is another tool in the toolbox for us to be able to do that. It gives you a different lens on corporates, sovereigns, munis, securitized, and any other kind of investment that we're making. Given that ESG is still an emerging practice, I feel like I've been doing it for a really long time, but it's still very new. It still has very evolving data sets. I think that any good ESG investor really needs to be leveraging academic research, probably more so than you traditionally did in your career before you got into ESG. This is the case if you're using ESG just to deliver better financial outcomes. It's also the case if you're trying to deliver better sustainable outcomes for your clients. You want to make sure that the way you're crafting a portfolio is actually targeting the right sustainable outcome. It doesn't just look good on paper to clients. Given that the rules and the baseline of what we're analyzing is constantly evolving, we need to stay on top of it. To say another benefit of academic research in my day-to-day is that it serves as a very good proof point. I think any ESG practitioner at an asset manager is going to tell you that getting mind share and buy-in from our portfolio managers is crucial. Sometimes it's easy. On other factors, it can be a bit more difficult to do. And academic research can serve as a great proof point for us to be able to convince an investor why a specific ESG factor might present an outsized risk or an outsized opportunity for a particular investment thesis. So to all the academics in the room, thank you. Keep up the good work and keep it coming because we're using you both for inspiration and also as that proof point that we need to get across the line. So this year's prize winners were picked from a very high quality set of submissions. I would urge all of you to read the 2 winning papers. For the Best Paper Award, it was Sustainable Investing, Evidence from the Field by Alex Edmonds, Tom Gosling, and Dirk Genter. And then the Best PhD Student Paper, Inattention to the Coming Storm, Rising Seas and Sovereign Credit Risks by Atreya Day. So with that, I will let you get on with the agenda of the day and turn it back to Lloyd.
All right, we will take our seats. Just to briefly introduce you to our group, let's see, Haoyu Gao, professor of finance at Renmin University of China, will be our first presenter. Ryan Lewis, associate professor of finance at the University of Colorado, will follow him. Caroline Flammer, Caroline, are we going with economics professor today? Okay, economics professor at Columbia, asterisk, among other things. And then Sylvaine Rolls of the PRI, senior specialist in nature. Caroline will be our academic professor. Sylvain will be our practitioner discussant. Haoyu, I think you have the privilege of the first presentation. I'll take the seat next to you, and then you take the podium.
Thanks, Lloyd, for the chairing the session. So let me put on the slides on the screen. So yeah, let's wait for. Yeah. Oh, okay. Thanks, Caroline. So, good morning, everyone. So, thanks to UNPRI for organizing this fantastic event and having our paper on this great program. I'm Haoyu Gao from Renmin University of China. So, our paper wants to estimate the financing cost of biodiversity conservation. So, as we know that protecting the biodiversity is a very perilous thing for human beings. And a lot of the research papers and the weather reports, they show that over 50% of their GDP depends on the nature, and a quarter of species go extinction and with a century. So that's also some reports by the World Economic Forum showing that the biodiversity loss and the ecosystem collapse, they rank the third for the long-term risk factors. So, and achieving such kind of protection goal, it requires a lot of the capital investment, okay, additionally. So there are some estimations on that. So there are over $700 billion per year for the additional investment. And a lot of leading scholars in this area, including Caroline here, and they do a lot of research how to incentivize such kind of positive externality events, okay? So it's very important. So, and we know that protecting the biodiversity has achieved the positive externality, and we know that so the government or public capital should take move the first or take the responsibility for that. So our paper want to join this way and to discuss how the financial implications of the decision of protecting the biodiversity. So our paper's question is how investors price in such kind of the biodiversity, the conservation, the campaign, the transition here. So from the point of view of the investors, so they have several trade-offs in front of them. First off, so the investors may balance the short-term transition costs. That means the protection is costly in the short-term run. And we also know that so the achieving such a kind of protection goal it can get some benefits or can get some we call that the sustainable the probabilities, but now in the short-term run versus the long-term run, there's some trade-offs here. And moreover, the investors from the national-wide or from the global side, they may do not care about the local biodiversity improvement for the particular area. So there's still some the concerns here. So that's why our paper want to empirically using the citing of the context of the policy change to evaluate how the market investors in the private sector, in private capital market investors, how they price in such kind of biodiversity protection. So our setting is based on is a China setting. They call it the Green Shield Action. So it is the top-down policy shock and then initiated in 2017. So it is the first event, the first policy change in China to achieving such kind of protection. That means it's a policy started in 2017. So they have the very clear target areas. We call that the national natural reserves. Okay, so that means for the local cities, they have this kind of the national natural reserves. They have the particular rule for protection of the biodiversity. So for the control group and the treatment group, we can estimate how the economic impact of protecting such kind of biodiversity affect the financial markets. Okay, and moreover, so we based on some of the data, the government official the disclosures. That means so the policy do take the effects. That means over 20,000 issues are found, and so on and so forth. And moreover, the local governments have little discretion on the establishment of national natural reserves and also the implementation of the JSA. So we want to argue that the instrument is from the local government financing vehicles, the municipal corporate bonds, and the policy change is from the government. So we want to argue that it is pretty exogenous from the research setting. And moreover, so the local governments should take the burden of their protections, because this policy change is this kind of policy that enforce the local governments to correct or to this human misbehaviors located in these national reserves. That means before the shock, there are a lot of pollutions and economic activities in the national natural reserves. And after the shock, the central government top-down policy arguing that or pushing forward that, so the local governments should take care of this kind of activities. And so, but the cost should be taken or bear by the local governments. So this is the intuition of this our paper here. So our empirical strategy is a very, very standard diff-in-diff analysis, and we compare the cities with national natural reserves versus without national natural reserves. So we can see that we do the pre-trained analysis. We can argue that the national natural reserves are pre-existing determinants. That means the treatment group and control group are predetermined before the shock, and after the shock, the treatment group, the yield spread jumps. So this is what we observed in the data. So, and we also, what we focus, the dependent variable, the outcome variable is the market-wide financing instrument for the local governments. We call it the municipal corporate bonds. It's a large, the assets in China. So preview of our findings, okay? So we find that the treatment city after the shock has the yield spread jumps by 24 bips. So this is a large amount for in terms, if we do some simple back of envelope analysis, we find that for those kind of pricing pattern, for the local governments with this kind of national natural reserves, so it is the additional financing cost that should be taken by the local governments. So that means that for the local governments who are responsible for the biodiversity protection, so actually they want to require the capital from the external market, but the bad fortunes never come singly. That means you need the capital for protection, but the financial markets do not realize that, okay, the benefit thing. They just care about the short-term costs, and they also punish you in terms of the financing premium. So this is what the implication of our paper. And that means for the central governors, the policymakers, they should have to balance two sort of the sustainability. The one is environmental side, the biodiversity side. Another one is the physical side, it's the economic side. So if we want to pursue the biodiversity protection goal, which is good, but we should still have to consider that, okay, the financial cost of being sustainable or protecting the biodiversity, how to internalize this kind of incentives is very important for the policymakers. And the second part of the paper is one we will pin down the potential mechanisms, and we also do some heterogeneity analysis. We find that our pricing pattern is mainly driven by some short-term bonds, and it means incentives are not aligned for the short-term the maturities. And we also find that the effect is even stronger for the local governments with weaker the physical conditions. And in the last part of the results, we follow the literature, we discuss the value versus values, and we collect the biodiversity data in the context of the birds watching. So we find that for this, after the policy change, the treatment cities, their local biodiversity do improve. But unfortunately, the capital investors, the market investors, do not care so much about such kind of improvement. So that means for the cities, for the local cities with more improvement of the local biodiversity, but the pricing is still there. It's not insignificant change by the local biodiversity improvement. So this is, the takeaway from this, the last part of the result is for the local, the investors currently in China. So we find that the market investors, they do care about the value side, the cost benefit side, the economic side, but they do not so much care about the values here. So the biodiversity improve, but the market did not respond. Okay. So I think it's the whole paper after paper. So this slide, we just want to argue that the national natural reserves, our treatment group, is pretty exogenous. We want to argue that it is the label of the national natural reserves is mainly depends on the distribution of natural resources or the DC factor of the natural resources. And moreover, I think the national natural reserves is determined by the central government. It cannot be affected by the local governments. So this is what we want to argue that, okay, the local government has very few discretions and control on the national natural reserves. And moreover, from this figure, we want to show that as the blue dotted line and the green bar, you can clearly show that, you can clearly observe that our national natural reserves, our treatment city, are established even several years before the shock. That means before the shock, the national natural reserves are already there, and the treatment group are already predetermined there. And we just want to compare for the treatment city and the control city after the shock, what's the difference of the yield spread. And the heated map just want to see that. So the national natural reserves, they do not concentrate in some certain areas. So it is just want to show you that. And our data, we use the municipal corporate bond data. It's very standard data in the literature. And we collect some alternative data in terms of national natural reserves. We have the GIS data, we have satellite data to prove the mechanism test. Okay, and I will show you later. So our baseline results showing that as a column 4 of this table show that the 24 bips point additional cost for the treatment cities after the shock. Okay, and this is the dynamic the DID results, and you can see that there are some lag effect and also have the persistent effect. So in the paper we discuss a lot about the details, and but due to time constraint, I do not expand too much about that. And to pin down the mechanisms, we want to highlight this kind of the intuition that correcting such kind of human activities within the national natural reserves, so this should be costly. Such as in this case, we collect a case in Beibei district in Chongqing city. It is Jinyun Mountain National Natural Reserves. Before the shock, there are some real estate, there are some mortgage here, and after that, the local government should crack down and should relocate the human citizens out of there. So it is very costly. So some estimations show that about 15% of the physical budget are allocated for this kind of particular events. Okay, so it's very costly for the local governments. And in line with this kind of intuition, we collect the data of the satellite data. We capture how much the human activities within the NR before the shock. As the red line shows, if before the shock, the human activities, there are much more human activities within the NR, so the cost effect should be stronger. So it's clearly showing this chart, and we do the interaction terms and find the results are very similar. And we also find some direct evidence that the local governments, they do spend the public spending on this particular events. And that means that after the shock, the treatment cities, the governments, they put a lot of government spending to buy or to protect the biodiversity zoo. And it is a city panel regression analysis show that after the shock, the treatment cities, their physical deficits becomes worse. And we also find our results are mainly driven by the short-term bonds, as I mentioned that earlier. And in the last part of the result, we collect the biodiversity, the e-birds, the birds watching data. We find that before the shock, you can clearly observe that in terms of the specific, the species, the broad species, the number of that, so it declines a lot before the shock, but after the shock, it reverses back. But unfortunately, we find that the bond pricing results does not change so much. I mean, that's what I highlighted earlier. That means the current stage of China, the market investors do not care about the values. How about the improvement of biodiversity? So they do not change their pricing pattern. So what they care about is the short-term transition costs. Okay, so this is what we want to highlight. And I think in the last 2 minutes, I want to link our paper to the literature as an academia guy. So first one, our paper want to link the natural capital and the biodiversity conservation, the literature. In this literature, you can see that clearly. So a lot of papers, discuss about the benefits. We know that the benefits of that, but there's starting point. There emerging literature discussing how the cost of the being sustainable, how the cost of protecting this kind of biodiversity stuff. So this is what we want to add on. And another one is the emerging literature, very recent papers, a lot of recent papers, and the biodiversity in the financial markets. And mostly, I think the literature, what they did is they construct the measures about the biodiversity footprints, the biodiversity risk matrix, and to see how the stock market, how the financial markets values or price in such kind of factors. But what we did is we use the fixed income market, and we find the local governments financing vehicles. If they want to financing their local governments, okay, if they are affected by some top-down policy change, pushing them to achieve the biodiversity, the goal, and the financial cost is 24 bips, and additionally, a cost they have to take in. And moreover, we also want to link the literature about sustainability and climate finance. As we know that in the past decades, a lot of papers talk about the carbon, the climate finance, a lot of very, very, genius papers. But nowadays, we know that the carbon issue is not that exactly the same with the biodiversity issue, because for example, the carbon things is quite different from the biodiversity. I didn't have much time to expand that. And the last point I want to highlight the impact investing here. So it's also another, the value versus values, the literature is also increasing. So I think in the last slides of my presentation today, so I just want the policy implications here. So this paper is used the context of China, but the topic is discussed today is definitely beyond China, and it can have general validity for the other the countries, and especially for the developing countries in the world to balance these two sustainability, the physical one and the environmental biodiversity one. And also I want to recommend you guys to read the papers by Caroline, the blended finance and the biodiversity finance. Okay, it's very, very smart papers. So thank you so much, and look forward to Caroline's discussions. Thank you so much.
There you go.
All right, well, thank you all for attending this session, and thanks to the organizers for having the paper on. So I think it will come as no surprise to many of you in the audience that, let's get that on my way. The US West is facing extreme droughts. It's like, they call it like a millennial drought, millennial super drought in the US West right now. And that's sort of evidenced by satellite photos of Lake Mead, which is the primary reservoir for Las Vegas, is at just all-time lows. They don't even think there was a threat that they weren't even going to be able to pump water out of Lake Mead. And it was exposing some of the sins of Vegas past. The water levels were so low, we were getting the mob, the people in a barrel washing up on the shore. So, as a resident of the U.S. West, this occupies a lot of my time. As a skier, it occupies especially a lot of my time. And I was discussing this with a natural scientist at CU, and they were saying, look, in 20 years, there will be nobody living in Boulder. And this came as a shock to me because I love living in Boulder. And I started this project trying to reconcile. This is a natural scientist who knows exactly what he's talking about on the physical science perspective, but I really do think that in 20 years, people are still going to live in Boulder. What is going to bridge the gap here? Well, as an economist, what bridges the gap often when you have a scarce resource is a market. A market can equate supply and demand over places or in time, bringing demand forward or supply forward. So that's what I sort of started down the path of. How can markets help us think about the water crisis in the West? Well, I think that the way they're going to do it is by doing the thing that markets do. So distill information about the future scarcity of these assets, so that we can make better decisions today. Now, the fundamental problem here, there aren't functional water markets in the US West. The US in particular has defunct system of allocating water rights. And so all of the benefits that come along with that are not yet realized. Now, if we can do this, if we can have accurate prices that allow us to think about the information in the future, we can actually avoid some of the irreversible harms that we face, right? So desertification is one of these states of the world where it's really hard to recover from. Ecosystem collapse, right? It's really hard to get that biodiversity back once an entire ecosystem collapses. I always think about the individual who chopped down the last tree on Easter Island. Had there been an appropriate market price for that, I don't think that tree would have been chopped down. So what I'm going to do in this paper is I'm going to think about how can water markets in particular help us think about long-term risks, climate-related risks, and what does that mean for sort of how we trade off water in the future and water today. Okay? So I'm going to answer two main questions here. The first is, do water markets think about long-term risks? I mean, markets don't think, but do the participants in these markets incorporate climate change-related risks in prices today? Right? I'm going to look at Australia for this, since, as I said, we don't see these markets in the US, and my answer is going to be yes. In water-constrained regions, long-term claims, a claim to own water forever, basically, trades at a 40% premium to the same claim in regions that aren't predicted to have shortages in the future. Now, what's critical is that these two regions are basically the same today. It's just one is predicted to have shortage because of climate change risk. Okay? So we find that markets do appear to have this forward-looking, climate-related lens to them. Now, this is great because this allows us to use these prices to guide investment today, to guide creation of water storage, and many of the other types of actions we would want to take based on that future scarcity information. And then the second question I'm going to ask in this paper is there anything particular about water markets that let us learn really important parameters about how we should think about climate risk? I'll talk about water as a hedge asset in a second, but again, my answer is going to be yes, that water markets actually provide us with a unique setting to figure out a reasonable market-based climate change discount rate. And that's going to be important from a policy perspective for lots of policymakers. Okay, so as I said, we don't really have water markets in the US. My focus is going to be on Australia, the Murray-Darling Basin. In 2004 and 2007, they created a bunch of legislation to centralize and make transparent all water market transactions in Australia. Prior to that, it looked a lot like our US West, with interstate compacts determining flows. After this, you had a pretty free market system for allocating water rights. And they created two types of claims. The first claim is an entitlement. For the investors in the room, we can think about this like owning preferred equity. It's going to pay a dividend of water every year. That dividend is uncertain, though. So you don't get, your claim is a fixed amount of water, but that can vary depending on the year, depending on scarcity. We call that annual allocation an allocation, okay? So the entitlement is this long-term claim that gives you some cash flow, some payment stream every year. The allocation is a seasonal water right that you can also trade with individuals seasonally, okay? You could use it to water your own crops, or you could sell it to another individual. Both of these trade readily. So you can trade long-term claims, or you can trade short-term allocations. And they trade within these zones, which are catchment areas, okay? And in particular, if I owned a 100 megaliter entitlement in Upper Naumoi, I could trade that to anyone in my catchment zone, in the Naumoi region, okay? You can trade upstream, you can trade downstream, no problem. What you cannot do is trade that to somebody in another catchment. It's way too expensive to transport large amounts of waters, big distances, okay? All right, so this sets up the analysis I'm gonna do. You have tradable rights, but they are isolated geographically. And so any risks that are faced by a particular region will be reflected in the prices in that region, but are unlikely to affect other regions. There could be some spillovers, and I'll talk about that in a little bit, but that's gonna set up my basic research design. Okay, this is just to fix sort of mentally what's going on. This is aggregate prices across all of Australia through time. So from the introduction of these markets through to 2022, here's what prices look like. Entitlements have increased a bunch. Lots of people have come into this market, driving prices up. Allocations move up and down seasonally. Okay, there's not a secular trend in allocation prices. What do allocations respond to? They respond to weather. Okay, so seasonal water responds to current weather. And this is perhaps not surprising, nor are these findings unique. So within the water rights literature, lots of people have demonstrated similar things. But the key takeaway from this is the last column, which says that when water becomes more scarce, the total value of an entitlement claim actually goes up. That is, the quantity you get goes down, but the prices go up more than the quantity declines. And so you end up with a more valuable asset in drought periods, okay? That's why I call this a climate hedge asset. So if climate change is worse than we expect, the IPCC models predict lower precipitation and lower runoffs in the Australia region. These entitlement claims will actually become more valuable, okay? There aren't a lot of those out there. There aren't a lot of assets that pay off more when climate change is worse. Okay, so let's talk about climate risk. The next portion of the paper, I'm gonna map everything to IPCC forecasts. So I'm gonna map each catchment area, each water trading zone, to our sort of best forecast as published by the IPCC. Red areas are gonna be areas with lower runoff in the future, blue higher, and gray neutral. Okay. Then I'm going to define regions as exposed to climate risk as above and below median. Of course, you could do lots of different measures to define this risk. It doesn't really matter. The results are going to be the same. And then I'm going to show you prices on an annual basis. Allocation prices do not seem to have responded to climate change risk. That is, the projections we made in 2014 don't appear to be affecting supply already, okay? So more regions that are meant to get lower water, that's the red regions, don't have higher allocation prices now. But there does appear to be a secular trend in entitlement prices, in the long-lived asset prices. And what we see is that by the end of the sample, high climate exposed regions are trading at about a 40% premium versus low climate exposure regions. And that's controlling for all of the current weather conditions today. So you might be concerned, well, weather, not long-term risk, could maybe drive prices in both areas. This water market is actually really nice because it lets me directly control for that, right? I can put in all of the prices and weather into these regressions, and it doesn't change my estimated coefficient at all. That is, this seems to be about future weather, not current weather. You might be concerned about some other sort of a emitted variable, population dynamics, productivity dynamics, etc. It's actually quite nice in Australia because they have broader agricultural regions that allow me to control for time-varying trends within these regions, but still look at catchment level prices. And what I find is when I include these controls, you still see exactly the same pattern with entitlement prices. Okay, so hopefully I've convinced you that water markets in Australia, at least, appear to embed information about climate change in their prices. Now what I'd like to do is use that information to figure out something about climate-related discount rates, a key policy parameter. So what I'm going to do is I'm going to take the price difference in the entitlement market between these climate-exposed and non-climate exposed areas. And I'm going to use that first table I showed you to estimate the elasticity of cash flows based on current weather. And then the last thing I'm going to do is from the IPCC, just take it seriously. I'm going to project out exactly the rainfall changes using this elasticity, and that's going to allow me to figure out what is the cash flow difference between exposed and non-exposed areas, okay? I have a price difference today, I have a projected cash flow difference, that allows me to back out discount rates. And what I find is that as a baseline formulation, climate hedge assets trade at about a 1.3% lower required rate of return than non-climate hedge assets. You could think about this as an asset with like a -1 beta, okay? And I'm running out of time, so I'll just conclude there. What we do in this paper is show that water is a hedge, climate hedge asset, that it appears to be priced by market participants, and we can use those prices to extract meaningful discount rate differences. Thank you.
It's fantastic. Thank you to our academic speakers. And now with a rebuttal, Caroline.
Wait, how did you know?
Our academic discussant, Caroline.
Oops. Thanks so much. It's great to be back. I'm not sure I ever left, but it's great to be back at the PI conference. Thanks so much for inviting me to discuss this study. Let me start by saying I'm super delighted to see more work on nature finance. We need way much more work in this space, not only in practice, but also in academia. So super delighted to discuss these two studies. Let me start with the first one on pricing the priceless, the financial cost of biodiversity conservation. And I'll give you a very brief summary, and then I jump into kind of the three main discussion points for each one of the studies, trying to stick to time here. So this study examines the Green Shield Action, which is a major government regulation by the Chinese government that basically enforces biodiversity preservation rules in what they call national nature reserves. So this is the NNR. As a methodology, they use a diff and diff, meaning as a treatment group, they look at those Chinese municipalities with the national nature reserves regulation imposed, and as a control group, those communities without, okay? Their main findings include that for the NNR municipalities, they find that this government regulation is essentially improved in local biodiversity, okay? So more specifically, the number of birds went up. Then also they find an increase in bond yields and that the economic costs are higher in these regions. Now, the authors conclude that our results indicate that investors show little consideration beyond the financial payoffs towards endeavors counteracting biodiversity loss. All right, now let me get to my three discussion points. And the first one relates to the framing and the interpretation of the results. So, as I mentioned before, the study looks at government regulation that is imposed by the government as opposed to actual investments into biodiversity, okay? And so accordingly, investors don't really invest into nature, correct? So the protection of biodiversity takes place anyway because it's a government regulation. And as such, in my perspective, this setting, it's a great setting to actually study what are the financial costs in terms of public funding when there's government regulation protecting certain zones, but it may not be the ideal setting to actually study non-pecuniary motives of investors. And so perhaps it's not surprising that the authors find that investors show little consideration beyond financial payoffs, because again, the setting doesn't really allow you to study this question. And so as a suggestion, I would recommend to reframe the study accordingly, okay? Focus on the public funding aspect and on government regulation. So it's not financing into nature per se by private investors, but it's really communities. What is the cost of government imposed regulation, which protects biodiversity? All right. Then my second comment relates to the measurement of biodiversity. So I love birds, and I know this sounds sarcastic here, but I actually really love birds. Now, while I do think birds are helpful, but it may not be the most comprehensive metrics to capture biodiversity. And so either you reframe the study around birds, okay, or the good news is there are actually other databases out there that you could use to get at biodiversity. And here I have a couple of examples. So there is satellite-based ecosystem data. I know this data is not really used by kind of business school professors. It's rather from the environmental economic side of things, okay? But the good news is it's data out there and it's totally under-leveraged in our fields, okay? So this includes the Human Impact Index measure of cumulative human pressure on ecosystems. We have the Global Biodiversity Information Facility and the IUCN Red List, and I believe all of them are actually publicly available. And we have satellite-based vegetation measures. So I encourage you to actually use these measures to get at a better measure of biodiversity. Okay, all right. Now, my third comment relates to identification. And so the authors in their definitive, they compare municipalities with and without NNR, so with and without basically this regulation. Now, the question, of course, is how comparable are these municipalities really? If you look at figure 2, which is this map, it suggests that, that there is quite some clustering going on, that where the NNR is, these are the darker bluer regions, it doesn't seem like the location of these regions is random, and so it's possible that other factors are driving this, that something else might be going on that is driving the results. All right, so my suggestion here is ideally what you would do is provide a characterization of the two different groups, NNR versus the treatment group versus the control group, show that they are very, very similar based on several observables prior to the government regulation, correct? Now, if they differ too much, you may want to consider using a matching. And alternatively, to sharpen identification, what you could also do is a sort of border design, where you look at neighboring communities and show, because neighboring communities might be more similar in terms of cultural aspects and other aspects, correct, a climate or so, and you might get closer to identification there. And that's it. Okay, let me move on to the second paper. I have less than 5 minutes left. Okay, so the second study is on the value of climate hedge assets, evidence from Australian water markets. Again, brief summary, and then I go into the main discussion points. So the study explores how water entitlements in Australia act as a hedge against climate risks, particularly those arising from water scarcity due to droughts or climate change. The main findings are that, so the paper shows that since 2014, entitlement prices in climate-exposed areas have increased about 40% more than other areas, and allocation prices have remained similar, okay? And so under a set of assumption, the author then estimates an implied discount rate premium for climate hedge assets of about 1.2%. First comment is about liquidity, okay? So the main analysis compares the price of entitlement rights versus allocation rights, and this allows the author to account for the potential confound of short-term risk exposure and short-term cash flows. Now, I think this is fairly smart, pretty smart, but I would love to know much more, okay? I would love to know, for example, whether, how much trading is there really going on of these rights, of entitlement rights versus allocation rights. If there's not much trading going on, if there's not much liquidity there, then the question is it really informative, correct? So I think you could help support your arguments if you showed a little bit more or explained a little more how liquid this market is. Also, if the liquidity of the entitlement rights versus allocation rights differs, this may affect the price comparison, correct? So I think you want to delve deeper into there. So my suggestion here is examine the liquidity of entitlement rights versus allocation rights separately. Well, those and separately, sorry about that, in high versus low exposure areas. If they differ substantially, then you may want to control for liquidity. Okay. My second comment relates to climate risk exposure and the interpretation. So you distinguish between high versus low exposure areas based on the median runoff risk, based on the IPCC. Now the question to me is, well, my question to you, not to me, is how much spread is there in this risk exposure really, correct? So in a sense, understanding this matters for the quantitative interpretation of the effect. Okay? So suggestion, provide more information on the magnitude, and you may want to actually consider using finer cuts, such as quartiles or quintiles. At this moment, you look at the median above and below. Okay. All right. Third comment is about identification. So this is very similar to the other study, to the first study. So the study itself is not similar, but my comment is similar, okay? And so here you compare high exposure versus low exposure areas. The key assumption of the paper's identification is that those areas are basically very similar, correct? Based on a wide set of observable characteristics, but it's unclear whether this assumption really holds. So I think providing more evidence there would be helpful, especially if you look at this map. It does seem like these regions might be quite different, correct? So, all right. So suggestion, again, similar to my suggestion for the other study, provide a characterization of the high versus low exposure areas based on observables. And then if they are very different, first of all, you may want to use a matching, and you may want to use a border-like design. Potentially looking at mountains, I don't know. Like, can you actually really compare different regions that are really very similar, and so. Okay. Actually, I have a fourth comment here, and this goes beyond the paper, okay? This goes way beyond your study. More generally, I would say, when we talk about hedging climate risks. So if we think about it, I guess this is a comment to the entire profession. To hedge a risk, you need to find an investment that goes up when the risk materializes, and you can use this investment to hedge your portfolio, correct? So this is basically, in this sense, in this study, this means that entitlement rights work as a hedge in the study. Now, more broadly, going way beyond your study, okay? Can we truly hedge climate risks? Even if the planet goes up in flames. Can we hedge climate risks? First of all, we don't really hedge climate risks. What we really mean, and I think folks outside of finance may not understand it this way, but what we really mean is we hedge the portfolio's risks against climate news or climate events in the short term. But we need to really understand that the key theory in finance, modern portfolio theory, don't ask me why it's called modern, but it's called modern portfolio theory. The key assumption is that systemic risks are exogenous, not endogenous, correct? And so we just assume away that our investments have anything to do with increasing risks and costs of climate change or biodiversity loss or any of these disasters. And similarly, we do not take into account the increasing risk and cost of climate change on our portfolio's financial performance. So we may need, so this is kind of a call for action for each one of us. We may need to modernize modern portfolio theory and then endogenize those risks. Thank you.
Thank you, Caroline. Sylvaine?
Thank you. And I think maybe I'm going to start with a caveat to ask my fellow panelists to please relax. I'm not about to give you comment on your research. And maybe to give another caveat, I'm not about to explain whether or not you can hedge a climate risk. My name is Sylvaine. I'm a senior specialist on nature at the PRI. And what I wanted to give you a bit of an idea of today is the key takeaways from those papers and how this reflects what we hear from our full signatory base. We've got over 5,000 investors globally, asset owners, asset managers, service providers, and nature has really come to the fore. Now, I know I'm biased because that's my topic of focus, but it is impressive the number of investors that come to us to ask for guidance on how they can integrate nature and biodiversity into their investment decision making. And I think those papers provide valuable information in supporting those efforts. There's three key ongoing debates, topics, research area that I really wanted to reflect on. The first one is on time horizons. Impacts from climate change and biodiversity loss have often been perceived as long-term potential, long-term impacts. However, recent disasters globally have really shown that no, impacts are here and they are now and they are significant. The topic of water security, for example, is one that's particularly prevalent in regions affected by drought or by increased water scarcity. I think the physical impact from biodiversity loss may not be as felt as of yet, and that's for a variety of reasons, including in terms of how certain externalities are accounted for or indeed not accounted for. But there's been efforts in general to try and put a financial or monetary value as to the implications of the physical risk from biodiversity loss. And so seeing research being published looking to put those figures forward is particularly encouraging because it helps investors build the business case internally as to why they need to start managing those risks, because they are not long-term risk, they are short-term or mid-term risk. And we had a recent discussion with a group of investors on what type of risk do you find most compelling when looking to build a business case on the topic. Is it physical risk, transition risk, or systemic risk? And there was a general acknowledgement that there is, the industry as a whole has come to accept that climate change and biodiversity loss are systemic risk. But that is not yet felt in the day-to-day investment decisions. It is not yet accounted for, and we need to bring that systemic level understanding to our day-to-day work. And again, being able to put a monetary value on some of those risks allows a better assessment and indeed, as a result, a better accounting of some of those risks. So time horizon, bringing it from long-term to short-term is absolutely key. Amongst the different type of risks that we discussed with that group of investors were also transition risk. And they were flagging transition risk, in particular regulatory risk, were among the most compelling for many of them, with an increasing set of expectations from both a topic perspective, but also a disclosure perspective in relation to nature. And this brings me to the topic of the importance of an enabling policy environment. This is a key pillar for PRI's strategy in terms of fostering an enabling environment for responsible investment by influencing government and multilateral policy and financial market practices. And as shown by this research, the rules of the game will determine how successful some of the policies as well as investments will be and how likely we are to achieve our climate and nature goals. And in particular, we need to account for the socio-economic trade-offs, to your point of what's the physical, what's the economic considerations here. The papers also raised the important point of developing data and information from regions that may have been underrepresented in the research to date, in the scientific literature. And so I very much commend the authors for bringing us research from those particular regions, which will allow investors within those markets to say, well, this is what's happening in my backyard. This is very much impact that are happening in our markets and that we should account for, not just in regions that may have been more prevalent in research to date, like North America or Europe. Investors are conscious of the need of that enabling policy environment, and they are indeed being more and more vocal about it. I wanted to mention the 2024 Global Investor Statement to Government on the Climate Crisis, which was released during New York Climate Action Week, and which includes nature-related expectations. It's received over 500, all right, maybe I'll turn that down, 500 signatures from investors representing more than 29 trillion in asset under management. And earlier this summer, PRI published a nature policy roadmap, which includes our key expectations to policymakers to facilitate the implementation of the Kunming-Montreal Global Biodiversity Framework. Now, this is a very high-level global paper, but if we start looking at specific regions in the world, and if we use the empirical evidence available to us, we will be able to make much more detailed, granular expectations and communicate those to policymakers. This is something that we as PRI look to do in direct engagement with a number of key markets, but we also encourage investors themselves to do, and they are able in this way to rely on the research in their region in those discussions. And I wanted to mention as well the Investor Policy Dialogue on Deforestation, IPDD, which is a very successful initiative in engaging governments in Brazil, Indonesia, as well as increasingly in Europe and North America on the topic of addressing deforestation as a key driver of both climate change and biodiversity loss. Now, coming to my third and final point, I've mentioned the Kunming-Montreal Global Biodiversity Framework, and that particular agreement highlights the need to mobilize all financial resources to achieve its mission, meaning both public and private financial resources. That's target 14, and it talks of the whole of society approach. And I think the papers you have presented today highlight this need of combining both public and private money in order to reach our climate and nature commitments. And it outlines instances where the policy environment has fostered investment, has developed suitable markets in order to manage some of our natural capital or natural resources and ensure resilience as much as possible in light of climate and nature risk, which are ever increasing. There's ongoing negotiations as to the implementation of the Kunming-Montreal Global Biodiversity Framework. COP16 is happening in a couple of weeks, and there will be discussions around the monitoring indicators, how governments are going to track progress against each of those targets. And there is a real need for those indicators to be able to reflect private investments that are also contributing to the implementation of the Global Biodiversity Framework. And again, having the ability to show research where we have seen successful implementation of policies to crowd in private investment is so powerful. The PRI will be going to COP16. We are bringing a delegation of just over 100 people representing 70 different signatories from the PRI, and we expect many more in attendance through other delegations. And it's an important voice to have to communicate to policymakers and negotiators what does that enabling policy environment look like. Now, those are my three key takeaways in the context of our day-to-day work with the PRI and its signatories. And I really want to express my gratitude to our panelists today for all their research and work, because it is incredibly valuable for our signatory base, and we hope to go forward looking at this important research. Thank you very much.
Thank you very much. We do have time for Q&A. Please, go ahead. And we have a microphone coming for you here.
Hi, my name's David Bates. I own an asset management company totally focused on natural capital. In a previous life, I was a futures trader, and the derivatives that you talk about are okay if they're just used by the people who need them. But there are other players in the market, so the pricing doesn't always get where you want it to get to. People will trade the volatility of the volatility of the volatility against other correlated returns. I think the problem I see for biodiversity is not from the bottom, but from the top, and it's the measure of GDP. GDP looks at the flows of money, and it doesn't value the stocks, the natural capital. It's not part of GDP. And as long as we use that, we are, with the current economic system, we're actually committing the first crime of a parasite. Do not kill your host. And so we need to focus at that level, but we also need to know what the value is. And a very clever chap called Robert Costanza in 2011 did a valuation on natural capital. He came out with a number of $125 trillion. To put that into perspective, that's just over 2 times global GDP in 2011. So I would like to hear your views on a more top-down rather than a bottom-up approach to natural capital valuation.
Well, and I think this panel is an interesting one. Thank you for making this point. From an issues perspective, we have this question of natural capital, and that includes climate, water, biodiversity. Can't have bio without water, so you can't have biodiversity without it. So at the issue level, this is a systemic problem, and Caroline, I'm going to pass it to you in a moment, but you have these global systemic risks. The problem is the conventional modes we use to analyze these things, not just GDP, but in economics, the fundamental question is, do I make money? Do I lose money? Or in finance? In politics, the question is, did I gain political power or not? In society, the question is, have we culturally preserved our values and acted in accordance with them? All 3 of these are in play when we talk about natural capital because we don't have proper property rights in this system. Governments can come into play. What I really enjoyed about both of these studies was that they took the problems of a local place and interpreted the global problem in the context of societal, government, and economic constraints. Caroline, would you like to say a little more on that?
Yes, so thank you, and thank you for the question. I may not address the GDP question per se, but in terms of top-down, bottom-up, the typical way we've been thinking about addressing biodiversity loss and climate change and other system-level challenges is, well, if there's market failure, we need government regulation, correct? For example, regulating the price or the quantity. Theoretically speaking, that would be the most effective way to deal with this, correct? But where is it? Like, whatever the governments are doing, top-down, it's unfortunately not sufficient because otherwise we would not be in the midst of this crisis. And so then it speaks to, we do need public policy, we do need effective public policy and intergovernmental agreements. But again, they have not been that effectively implemented, if at all implemented at this moment. And so then this begs the question, what else is there? And so biodiversity finance, climate finance could be a potential way. And so this is where we all try to make progress in understanding what is possible, how should we think about it, what are the limitations. But I think the short answer to your question is we need both. And we probably also need to start thinking about understanding that we face an enormous financing gap, correct? So if we look at the financing of climate, biodiversity protection, etc., typically it has been funded through development funding and philanthropic funding. But we face an enormous gap, especially in the global south, where we need the capital the most. And so the key question becomes, how can we crowd in more private? There's tons of private capital out there, but it doesn't flow in that direction. So how can we crowd in more private capital to finance innovative solutions in climate tech, renewable energy, nature-based solutions, social innovation, etc., especially in the global south where we need it the most. And so this is where blending comes in. Hardly any investor, hardly any business school talks about blended finance, and I think that's where we really need to make advancements. I'm going to stop here. My answer was way too long.
If I could just add on a little bit there. One sort of embedded in your question, I think, is something about establishing property rights. When we don't have a clear owner of the atmosphere or of residual water in Australia, we tend not to account for it properly because we use it wastefully, right? And so one nice thing that emerged as part of this Australian reform was that starting in about 2018, Australia stopped relying on just the excess runoff to restore ecosystems. The government actually started saying, okay, well, here's the price of water this season. How much benefit would we get by actually just buying some water and running it off into some of these, at-risk ecosystems? And so they started making a direct trade-off, but that was only possible with prices and a market and all of the infrastructure necessary to make that trade-off in particular. So I agree with other panelists, like it is probably a marriage of private and public, but without a market to link these things, it's really hard to even make those trade-offs to begin with.
Other questions? Go ahead.
Since I have the microphone here, center.
Oh, sorry.
I have the microphone already.
Oh, okay.
Yeah.
Question here, and then we'll take this one, please.
Very simple, because I'm in the United Nations Pension Fund, and I feel bad that we keep talking about the gap, right? And what you have here today, and we keep hearing about this on and on and on, is that there's a gap on financing. What this conference shows you is that we all are willing to put money on these things. But what is lacking is projects there. You were talking about the global south. You were talking about the markets. It doesn't exist. Our capital is smart. We want to do it. We have allocations. We're ready to jump in when there's a good risk return, right? But there are not things happening in the global south or somewhere else to put the money in. So, and we don't talk about that. It looks like it's always the fault of the investors that we're not doing enough, but we're ready, right? But there are no solutions out there.
May I just ask for your name and you're with the UN and which?
Pension fund.
Pension fund, sorry, I missed that one. I'm less convinced that there are not sufficient investable projects in the global south. I do think they are. There's lots of innovation going on. But the question then becomes the perceived risk and return, correct? In a sense of, I think a key question is, what prevents us all to invest more, to come to the table, correct? And I think we need a much better understanding of the different types of capital providers, from pension funds, sovereign wealth funds, institutional owners, asset owners, all the way to VCs, family offices, philanthropies. What are their objectives? What are their preferences? At what risk return would they come in? And then understanding how can we puzzle it together. Another aspect is also the risk perception, the role of rating agencies. I totally agree with you. It's not just about the investors here, correct? But in a sense of, I think we need to change our mindset of looking at what's the issue and then how do we together find a solution as opposed to whose role is it? And the lack of data, lack of transparency is certainly not helping in a sense of, so we also need more case studies, we need more prototyping, and academia also plays a role in this, correct? So in a sense of what can academia contribute here? On one hand, we can do research for this, ideally we have data, to better understand what would be, how can we structure those deals? Another thing is also we can help educate, and there is a lack of understanding across the board, I would say.
Fragmentation is a big issue as well, right? Projects are very small. Fragmentation. That's another
But
thing.
then, correct, like how do you come from a startup, from a small project, how do you scale it up so that eventually pension funds, sovereign wealth funds can come in? But we need to think it through, like who comes in where, at what point in time.
Sylvain, would you like to add something?
And I'm not going to, there are indeed a number of challenges associated with trying to channel funding towards projects with a positive impact on nature. What I would, however, highlight is the UN published their State of Nature Finance late last year, showing that there is $7 trillion of annual investment, public and private, that have a direct negative impact on biodiversity. That's 140 times more than investments deemed to have a positive impact on biodiversity. And so the scale difference is crazy. And I think to the role of investors, there is a real and urgent need for investors to assess, well, what part of our portfolios or investments are having that negative impact, and how are we going to manage that? Because it is leading to risk, physical transition, systemic risk. It is also important to look at the investment opportunities, but indeed there are still some challenges associated with them. But in the short term, we would very much call on investors to understand what risk are they exposed to, where are negative financial flows, and what can they do in their work to improve that.
Fair enough. I think we have time for one more.
Hello? Hello? Well, I'm going to start out by saying to the gentleman that asked the last question, we've been doing particularly a good job with land restoration in Brazilian degraded pasture lands, and we've been getting about 8 and 9% internal return rates in dollars, so I'd love to tell you a little bit more about what we do. The question here is a little bit on Mr. Lewis's research. I understand, as Professor Flammer said, that Hedge might not be the appropriate way of looking at this, but I'd like to understand a little bit better how did the Australians do the water pricing? I feel like it's an indicator that might help price water for other aspects of the value chain. We work with land restoration in Brazil, and for you to restore land and restore systems, you need to have places where water is available, at least to get the process started. And one of the things that we do right now is try to look at patterns and rainfall patterns and so on and so forth. But I feel like a financial pricing system might in the long run, and as it expands, be a better way of predicting the places where the market feels like water is going to be available.
Yeah, I think there, from what I understand, a couple of questions embedded in what you're asking. One is, how do the prices emerge? And the prices emerge through just the market, right? People come, I want to trade my seasonal claims this season. I have too much water. Who wants to buy if a buyer's there? That's the price that I see, and that's the price that gets reported. The question of how much is allocated in any given season, well, that actually goes back to the holders of the water. So there's a consortium of holders that decide, okay, well, this season it's a little dry, so we're going to release a little bit out of the dams, and that will supplement the rainfall. But of course, that is extremely price driven, right? When the price starts to get really high, they start to release more water, and so they allocate water as a function of, or at least seasonally as a function of those prices. One thing that came about from this is a lot of public and private investment in redirecting water within catchment areas, right? Where they found that these water rights were really valuable, it suddenly became really valuable to dig ditches, to move it places, to try and preserve as much of it as possible. So a lot of that stuff just emerged as a function of the market signal existing.
That's terrific. Thank you very much, Ryan, and to all of our speakers today. Thanks to all of you for joining us. This is the first of 5 panels. We'll be here, well, they say we'll be here all the week. And as you exit, there are 3 QR codes there. three distinctive things. The first one talks about the PRI research program and academic network. Academic network now consists of 13,000 academics and practitioners. Second is an opportunity for you to share with us your academic interests. And the third is to express your interest in the lecture series. Many of the speakers in that lecture series are here and presenting during this conference. Thank you very much.